It's Brian Preston, the money guy.
This next question, let's stay on that sort of debt idea because this has come from SC Marbell. And we get this all the time, again, because you guys are financial mutants. And this is a question that's not black and white. There's some gray, and I think we'll share what the gray is. It says, how should 0% financing rates, available now from many dealers, factor into your car buying recommendations? I can pay cash, but it's hard to do it with 0% interest. How long should I carry out those payments? And we get this all the time, and it's not just 0%. We get it when it's 0.9% or 1.9%. How should I go about taking advantage of really low interest rates if I'm in the position to do either or?
Well, first, I mean, and we've talked about this, but I think it's worth repeating. The 23-8 rules we have with car loans, just to review really quickly. Remember, we think with any type of auto purchase, first of all, it can't be a luxury brand. If it's a luxury brand, it's 12 months, same as cash. So you got to make it through the gauntlet of that first. Once you know you're buying a non-luxury brand, this is more of a practical car. We're okay with financing as long as it's 20% down, you don't amortize longer than 3 years, and it's not more than 8% of your gross income. And then there's one other caveat. Your investments have to exceed, your monthly investments have to exceed what your monthly car payment is. If you get that backwards, you go really screw this thing up. So with those type of understandings, I get it. You especially because Bo and I just had this conversation recently. Like Honda is doing, I think, like 0% for 5 years. Yeah. So it's like, wow, I could really. There's an arbitrage situation I could potentially take advantage of. But here's the problem that always grounds me on vehicles. Vehicles are horrible for your balance sheet, your net worth statement, because they depreciate like a rock. So even if you're getting 0%, in the background, you can practically hear it. If you get quiet late at night, you can hear the loss of value just running out. It's like a cash register just quickly running. You hear cha-ching, cha-ching, cha-ching. That's the money just dumping out of the exhaust pipe of your car on how fast it loses its value. Because that's going on, that's why we do 36 months on the amortization. You can look, I'm not going to tell you, you can take a 60-month loan with Honda at 0%, but you need to pay that car off within the 3 years. Because it's depreciating, and I think it's just a good practice. Plus, it will also keep you honest from buying more car than you can actually afford with your wallet. Because I think sometimes that's the game that dealerships have figured out, is that when America is focused on the payment, not the actual total debt, we got a solution for that. We'll just extend this thing out to 6 years, 7 years, and we'll get your payment down to whatever you want it to. You'll just never actually own this car while it's still depreciating like a rock in your driveway. Don't fall victim to that. Get out of debt, and it'll also keep you, like I said, honest on what you can actually afford when it comes to cars.
Yeah, I think one part of the 23-8 that we don't often talk about as much, that doesn't get enough focus, is the 20% part. You got to put 20% down. Well, here's the real reason. In our opinion, one of the biggest risks you can run if you're going to own an automobile and you're going to finance it is becoming underwater on that auto, meaning that you owe more than the car is actually worth, because you may be the best driver in the whole entire world. But even if that happens and your car gets totaled, right? An accident happens, your car gets totaled. The insurance company says, okay, great. Hey, we're going to pay you this much for the car. You're going to get a check for $10,000. And you're like, oh, okay, great. But when you have a loan that's outstanding for like $14,000, you start thinking, oh man, not only do I have to go get a new car, I got to satisfy that loan that I have outstanding. You always want to make sure if you are financing a car, and even though if you're doing it over that 3 years, you should know about how much that car is depreciating over that 3-year period, and make sure that you always stay above loan value on the equity that you have in the car, meaning what it would be totaled for or what you could trade it in for.
Now, comment section, a lot of people have said, what about gap insurance? I mean, what are your thoughts on gap insurance? Because that's what I hear. We've even had people mention that in our comment section.
In my opinion, I don't think that gap insurance makes a whole lot of sense, because I think if you have the appropriate equity in the car, then you don't really run into that issue.
Yeah, why pay for something you don't need?
Why pay for something that you don't need if you're doing it the right way following 23-8?
This is not the arbitrage situation that houses have. A lot of people know that we have a different take on if you're under 45 years of age, those low interest mortgages versus investing. The difference is your house is not depreciating
right.
at 50% in the first, 3 to 4 years of ownership. And that 50% depreciation should scare the heck out of you, and you need to stay above, because remember, your whole goal is wealth building, not wealth losing.
That's right.
And automobiles are wealth losing behaviors. Treat them as such.
Love it.